and we're going to talk about inflation pressures and what that could mean for different assets. So starting out with the inflation data that's come out this week, we have core CPI, CPI, core PPI, and PPI. Now, CPI is Consumer Price Index and measuring the cost of goods that consumers spend money on. PPI is Producer Price Index and the cost that it takes to create the things that consumers spend money on, but the producer's level of it. So when PPI is rising, then the expectations are that we should see those prices either cost the company more and therefore reduce their margins, or passed on to consumers. And so PPI can be somewhat foreshadowing of CPI in the future months. So as we look at the data, every one of these numbers are showing higher. We're seeing higher numbers, higher than expectation or forecasted. We can see CPI, both core and regular, month over month and year over year, pushing us back to a 3% annualized rate. That is higher and hotter than what we should expect or wanted, at least according to the Federal Reserve. Now, the Federal Reserve, Jerome Powell, came out and said that don't worry about CPI. We focus on PCE, personal consumption and expenditure, which is fine, except for that PCE came in hotter last month as well, back the last week of January.